Hi, today we want to talk about FIRPTA. FIRPTA refers to the Foreign Investment in Real Property Tax Act. This was passed in 1980. Why? To overcome this perceived advantage that non-resident, non-citizens investing in U.S. real estate were doing so at a tax advantage to those who are U.S. residents or U.S. citizens. So it was a bit unfair. The main impact of FIRPTA is to treat the disposition of any U.S. real property interests as if it were effectively connected income. So therefore, it will be subject to U.S. taxes. Now, there's an expansive view of disposition, and it includes, but is not limited to, sale or exchange, liquidation, redemption, gift transfer, etc. Now, there are some exceptions, but assuming that you do not meet those exceptions, when you are selling your US real estate, the party that's buying it is legally required to withhold 15% of the purchase price, not the profit, but 15% of the purchase price, and to remit that to the Inland Revenue Service. So what that does, it effectively creates cash flow issues, or it creates a timing issue for the seller. Because if that withholding, that 15% off the top, is too much, then what you eventually do is file a tax return in the following calendar year, and you will get a refund of any excessive withholding, both at the federal level and for the states that do withhold. For example, California will get a refund as well. But then, assuming that you wanted to invest in something else or you needed that money, that can be pretty inconvenient. So, as I said previously, there are some exceptions. And there's also a way of, if you don't qualify for one of those exceptions, of legally avoiding that withholding requirement. And that's by getting a withholding certificate. We'll talk about withholding certificates in another video.